This is AET video 14. Here in this lesson we will make our first loan payment. This will give us a chance to practice the percent calculations that we have been working with in our previous lessons. Let's go ahead and take a look at our original loan. Head over to the Loan Manager in the Finance section. And there is our original loan, and we can see that on April 1st of 2019 we borrowed from Pacific Crest Federal Credit Union $2,000, and we haven't made any payments, so the principal amount still due is $2,000. Now let's take a look at the original transaction here. We're making our first loan payment, which is 30% of the principal amount, plus we also have to pay 2.5% as an interest charge based on the principal amount. So the interest is a fee that needs to be paid based upon the amount of money that we borrowed. So we'll head over to Loan Manager and then look at the Payments section. And then the window pops up and we can see a New Payment button. Let's go ahead and click that. And here at the Add Edit Loan Payment window, we see that the first thing we need to do, of course, is enter the date, which is August 1st of 2019. Now we can move down to the total amount paid, so what we'll have to do is bring up a calculator. And you should do this too. You'll want to practice. These calculations are pretty much the same as what we practiced in class. So we've got a principal amount and an interest amount. So we have to do two different calculations. So the first calculation then is going to be this 30% of the outstanding principal amount, which is the original loan amount of $2,000. So like we did in our practice sessions for percentage, we need to take that 30% and convert it to a decimal value. So we'll take that 30, divide it by 100, and there's our decimal value, and then we can take that and multiply it times the $2,000. So the principal amount of the payment, the amount going to actually paying down the loan, is $600. But we also need to now add in the interest charge. So I'm going to hit Memory Plus to save that. Go ahead and clear that calculator. And now we can calculate the 2.5%. So once again, I'll take that 2.5%, divide it by 100 to convert to a decimal, 0.025. Multiply that times the same $2,000. And that gives us $50. So the amount of interest, the fee that we have to pay for borrowing that money for this period of time is $50. Now I'm going to add back in memory recall to bring that $600 back up. So then our total amount paid is going to be $650. The amount of interest that we calculated, you will recall, of that $650 was that actual $50. So we need to put that in as a separate charge, $50 in interest. And then go ahead and type in the memo. First payment, 30% of balance plus 2.5% interest on the balance. I think you'll run out of space there, so I abbreviated balance as BAL. Now you take a look down here on the interest distribution. What percentage of it went to the show lamb? Well, in this case, we only have one project, and the entire loan was for the lamb, so that is going to be 100% of that payment is for the show lamb, which, as it turns out, is an expense. So that needs to be attributed to the show lamb. so that when we start taking a look at our reports, they are reflected accurately on the distribution of that interest expense. Look over that transaction, and we can go ahead and click Save. And then take a look here at the loan payment window and compare your information to what I have here and see if we are in agreement. We still have a loan amount of $2,000, but we've paid a principal amount of $600 plus an interest fee of $50. And so that will conclude video 14, making our first loan payment.